Hims & Hers is trading at $63, and I'm not yet ready to buy the hype. They've got 2.4 million subscribers, 73% year-over-year revenue growth, and a fat 76% gross margin. And that's the good part. But here's the thing that most retail investors are missing. 30% of their 2025 revenue depends on a compounded weight loss drug that might not soon even be legal to sell. The FDA already pulled semaglutide off the shortage list. If regulators crack down, that's $725 million in projected revenue gone. Oh, and of course, the stock's trading at nearly 89 times forward earnings. That's 5 times higher than the sector average. Wall Street analysts scream hold with a price target that's well below current levels. My name is Rick Orford. I've been trading since 1999, and I'm not a financial advisor, and that's a good thing. I'm not here to dress up numbers to make you feel good. I'm here to break down all of this honestly so you can make smarter, more confident decisions. So today, I'm going to do a deep dive into Hims & Hers, the growth, the red flags, the compounding drama, and whether the risk is actually worth the reward. Let's get into it. So what exactly does Hims & Hers do? Well, put simply, it's a direct-to-consumer telehealth platform. The company started out by focusing on stigmatized conditions that make people a little embarrassed to talk to their doctors about. Conditions like erectile dysfunction, hair loss, or anything you don't really want to discuss with a doctor. I want to thank the Motley for sponsoring this video. The Motley is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. The company has also expanded into areas such as mental health services, dermatology, and primary care, and the most recent one, weight loss, which is gaining a ton of traction and some controversies along the way. In terms of their business model, it's almost entirely subscription-based, which means recurring revenue. In fact, the majority of their revenue is recurring, and that is something I really like to see because it's predictable, right? There's no middleman, there's no insurance companies, no doctor's office. You just go online, get a virtual consultation, get your script, and then they ship the medicine directly to you. This is a very simple and incredibly effective business model. Okay, so let's talk about the stock, right? Because it's been pretty wild. If you want to follow along, go ahead and scan this QR code. Over the last 52 weeks, Hims & Hers has traded between $13.47 and $72.98. That's quite the range. The stock closed at $63.35, giving it a market cap of just over $14 billion. Following the release of their second quarter numbers, the stock dropped almost 13.5% after hours. So what exactly happened? Well, while the first quarter was an absolute blowout, the second quarter, at least revenue came in at $544.8 million, which was actually lower than the first 3 months of 2025, but yes, 73% higher than Q2 of last year. Lower revenue translated to net income declining to $42.5 million, which is still much higher than the $13.3 million that it reported in the same period last year. This translated into 17 cents per diluted share in earnings for the second quarter, which was actually 5.5% lower than consensus estimates, which is why the stock dropped after hours. Usually, when companies beat on earnings per share, the stock rises. So results may have missed estimates by a bit, but yes, I have to admit, the year-over-year growth is very impressive. So let's look at what's driving all of this, and it's just 2 words: subscriber count. In Q2, Hims & Hers subscriber count grew from 1.9 million to 2.4 million year on year. That's 31% growth. Meanwhile, average online revenue per subscriber grew 30% from $57 to $74, and that's huge. It means that Hims & Hers is getting more value from each customer by upselling or cross-selling instead of just increasing the subscriber count. For the full year 2025, management reiterated its previous revenue guidance from between 2.3 and 2.4 billion, which represents a 63% growth rate compared to last year. They've also restated their EBITDA guidance to between 295 and 335 million. Essentially, they're keeping their revenue expectations the same, but increasing profitability, which tells us that the company is getting more efficient as they scale. Now, let's talk about the stocks and some other financial metrics, because this is really where you need to pay attention as an investor. In terms of the stock, it's been moving upwards despite all the recent macroeconomic headwinds. Right now, it trades at $63.35 per share and has grown about 260% over the past year. That said, the stock currently trades at a forward PE of almost 89 times, which is very rich for a healthcare company. In perspective, it's more than 5 times more expensive than the healthcare sector average of 16.67. And this potentially means that Hims & Hers is priced for absolute perfection. And it's risky, right? Because any minor stumble could trigger a painful price correction, just like we see today. Wall Street thinks the same thing. In fact, the stock has a hold rating with an average price target of $47.67 per share, which is about $11 lower than the current price. Now, on the positive side, the company has minimal traditional long-term debt, aside from some senior notes that they issued this May, and it has cash and cash equivalents of around 1.1 billion for the second quarter, 870 million of which are from the senior notes. These senior notes are due in 2030, and the proceeds are earmarked for increasing global expansion and AI implementation. Another reason is the company's gross margin. For the second quarter, it came in at 76%, pretty high, but a tad lower than the 81% margin that it had in the same quarter of last year. All right, so I do need to address the elephant in the room, and this is something that we've covered before on my Discord server. If you haven't joined already, I recommend checking it out. Just scan this QR code. So, Hims & Hers jumped into the weight loss area in May of 2024 with its compound version of GLP-1 drugs. These are the same active ingredients that you find as Ozempic and Wegovy, but at a fraction of the cost. The company is selling these drugs at $199 a month, which is significantly lower than the brand name versions that can cost up to $1,300 a month. And this product gained a lot of traction. Management even expects it to generate at least $725 million in revenue for 2025, which makes up about 30% of its total revenue. However, the FDA recently announced that the active ingredient for this weight loss product, which is semaglutide, is no longer in shortage. And why does this matter? Well, compounding pharmacies like Hims & Hers are only allowed to make copies of drugs when there's a shortage. So this makes the whole $725 million target questionable, right? Then there's this whole Super Bowl advertising drama. Hims & Hers ran a provocative ad that attacks Big Pharma while promoting their own affordable product. Sure, it drew a lot of attention towards the company, but triggered a backlash from the pharma industry. As a result, the stock dropped from around $66 to below $30 a share in just a few months. Fortunately, the company was able to mitigate the damage. They announced that they would stop selling exact copies of the commercially available doses. Instead, they're going to focus on personalized doses that aren't commercially available, which now cost $69 a month. I would say it's a much more affordable version. And of course, after all the backlash, the stock climbed up to where we're at today. So with all that out of the way, we do have some risks to discuss, some issues that could derail the company's growth. Number one is the regulatory risk. The FDA's announcement was just a glimpse of what could happen. There's also an ongoing debate about the safety of compounded drugs. If the FDA decides to crack down even harder, it could hammer down on Hims and Hers weight loss business. And of course, the valuation itself is a risk for many. And it makes sense. You see, when a stock trades significantly above the broader sector, there's very little room for mistakes. Any missed targets or margin retraction could trigger a really painful price correction. Though most of these are yet to be seen, the risks are very real. So I wouldn't recommend betting the farm on Hims and Hers. However, if you do have a small portion of your portfolio set aside for riskier plays, this could be something that you can look at. After all, there's a lot to like about the company. The growth momentum is real, its overall historical financials are pretty solid, and it's addressing a real problem, the high cost of drugs in the healthcare system. And this is something that the government is also trying to tackle. So that's my take on Hims and Hers. What do you think of the company? Are you buying into their vision? Let me know in the comments below. And while you're there, if you found this analysis helpful, hit the like and subscribe button so other people will find this video as well. Thank you so much for watching, and I'll see you next time.